Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Casimir and I'm the Managing Director for Central Europe. In this episode, we'll be discussing tolling agreements, exploring the different structures, what is driving the price behind it, and where the trend is going. I'm today joined by Martin Daronnat, the Head of Flexibility and Structured Origination at ENGIE. At ENGIE, he's focusing on flexibility purchase agreements for BESS, pumped storage, as well as on a portfolio level. Before he spent his time at ENGIE, he spent 3 years at Vattenfall as the head of business development trading, 4.5 years at E.ON as a commercial development manager, as well as an operator for virtual power plants, and some time at Energy Pool and other stations. So very big welcome, Martin. Great to have you here. Let's set a bit the scene before we get into the first question. And I think the first one will be actually about how do we define the topic of today? Is it a tolling? Is it a flexibility purchase agreement? But we will see that in a second. So why are we looking at this topic actually? We're seeing a massive build-out of batteries across Europe, and in contrast to renewables, government-backed contract revenue streams are getting smaller if there's a capacity market and if that has been existing actually because of falling derating factors. And in many markets, no contracted governmental-backed revenue streams are actually existing. So that's a bit of a challenge. And of course, there are notable exceptions like Italy with quite a special system, but also in countries like Germany where you have some special forms of subsidy for co-located assets. Nevertheless, it's a very different situation than for batteries. And contracted revenue streams are quite key to make the battery projects investable, as they reduce the revenue risks, allow for project level debt, lower capital cost, and make the whole asset class investable also by infra funds. And all of that we have seen is quite key in pushing the build out and has been very successful on the renewable front across Europe. So the question of course is what can we do to get some contractable revenue streams? And as in the renewable side, we're seeing PPAs. So the big question is, what will we see in the flex space, or what are we already seeing? So maybe let's start with the first question, and over to you, Martin, to maybe explain us a bit better what is a flexibility purchase agreement, what is new about it, how does it relate to a PPA, and when are we actually talking about tolling, and what's actually the whole difference about these wordings?
Great. Yeah, let's jump in. Thanks for having me. It's a pleasure to be on this great podcast. Quite an honor, actually. So FPA for me is indeed like a very similar in its structure to a PPA. So FPA is F for flexibility. So you're buying flexibility. You're not buying power. When you do a tolling or like a contract with a flexible asset, you're not buying power. You're buying the flexibility which is underlying these assets. That's why I keep on insisting on that, because I still think that some people don't fully yet understand that what they get into these contracts is not power, but it's more flexibility. So flexibility purchase agreements, they are contracts around flexible assets. They can take the form of a merchant contract. They can take the form of a fixed price contract, like we have, fixed price PPAs and indexed PPAs for the renewables. But it's kind of the same, for batteries and for flexible assets. So you can fix a portion or the totality of your cash flows for a given duration, of course. You can also go fully merchant. You can have various structures which are also indexed, which are a bit in between. You can also have floors, and all of these things basically allow an off-taker to get access to flexibility or to an optimizer to basically provide services for a battery or flexibility asset owner. And for the flexibility owner, especially in case of fixed price FPA, as you said, that allows them to go to a bank or to a lending bank, to be specific, and leverage effectively their equity because they can raise debt suddenly. So fixed cash flows, exactly again similar to fixed price PPAs for the world of renewables, they allow to do exactly the same. And I would say that FPAs at fixed price are similar conceptually by what they allow to do, but in their structure, it's much more complicated, because effectively you could say, and that's often the shortcut that I take, an FPA is effectively a PPA, but combined with an optimization agreement, intertwined. And that's why they are typically more difficult. That's also why we see so few of them, at least at fixed price. being side, and even, like merchant assets that are really effectively optimized are still difficult contracts to manage, because you need to properly represent all the physicality and all the constraints that the assets which is underlying the contract, or the portfolio sometimes, which is underlying the contract has. So that is, I think, a key difference to a PPA. A renewable asset makes money, so to say, without being steered. A battery or flexible assets needs to be steered to make money, effectively. So that's the key difference, and that is the key difference between the two contracts, between a PPA and an FPA. So that's it. I would say in terms of structures, you have three types of main contracts for FPAs. You have the physical FPAs, the virtual FPAs, and the financial FPAs. One should not confuse virtual with financials. Physical FPA is something where you have an off-taker that takes control on the battery. So it can be merchant or fixed price. Again, I, as ENGIE, for instance, would take the asset into my balancing group, optimize it, connect it to my virtual power plant system, most likely, and then do the full optimization of it. And then we would basically, in a merchant case, share the revenues. In a toll case, then I keep all the revenues, but I pay you a fixed price against it. That's the first one. The virtual one, or let's start maybe by the financial one, which is the complete other extreme. It's a completely financial structure. There is probably even sometimes no assets behind. It's just like a payoff, basically, that one off-taker is willing to give versus another one which is willing to accept a given share of market risk by having these cash flows secured or not secured. So it's a pure financial swap. One party is paying fixed, the other one is paying variable, on which basis there's unlimited options there, I would say, for the financial world, but it's clearly a financial product. So it's clearly a financial product. The virtual toll is a bit in between the physical and the financial one. So a virtual toll is still a contract where there is something which is exchanged. So electrons, megawatt hours, are really exchanged between the two parties that are signing the contract. That's why it's not fully financial. At the same time, it's not fully physical, because in a virtual toll, the off-taker, let's say ENGIE, is not seeing an identified asset. It's probably a portfolio of assets behind. It's portfolio of many different types of assets, potentially, not even only batteries, in the case of batteries, FPAs. But it's something which is virtual in a sense that there is no identified asset, and nor necessarily like any concrete steering of those assets by the off-taker. So the off-taker is rather buying the ability or the right, to the option, effectively, to exchange megawatt hours with the other party, the seller. And the seller can back-to-back then discharge or charge the battery, or do trading, of course, for the ones that can, with the assets they have in their portfolios, to deliver or accept the megawatt hours that are exchanged with the off-taker. So again, physical, virtual, financial. So far in Germany, to my knowledge, there is only a few physical deals, because those ones are quite difficult. ENGIE was the first one to sign a physical FPA last year, effectively at fixed price. We are quite proud of it. It's technically difficult things, and the goal will be to sign more. There were a few virtual tolls that were publicly announced with TerraLayer, Vattenfall, and RWE, which are also great, I would say, deals to make the whole financing of batteries move forward in a different manner. Then it's a different setup, not necessarily for all clients doable, but still enabling some clients to get access to flexibility. And then the financial ones, I don't think that we have seen them so far. They have pros and cons. They are quite flexible, but when it comes to the full, let's say, triangle between the financial party, the optimizer that steers physically the asset, and then the seller, so the asset owner, there is always a bit of a discussion of what happens when the asset is touched, because the one that pays the fixed price is typically not the one that touches the assets. So that introduces to lenders, especially, discussions which are making these deals, I would say, slightly more complex, but I'm still convinced we will see a few of them. That's, by the way, potentially where the merchant optimizers, the smaller ones that are not credit-worthy, can enter a bit this game of tolling or fixed price FPAs via a different door, for especially utilities or banks that do not have the algo capabilities to steer an asset, but still want to be exposed to the cash flows or to the payoff between the fixed price and then the merchant revenues.
Yeah, very interesting. And I mean, it's indeed very similar to the classical PPA, where we also have similar differentiation, but as usual in the battery space, it gets more complicated. So just quickly on the physical versus virtual one, because as you say, the financial one can be everything, literally, as long as it's kind of looking at the risks that you have as a battery. It could be probably even going as far as some spreads only. But on the virtual side, I think this is quite interesting also because you're mentioning this is probably the most common one at the moment in Germany. You said that this is particularly important for portfolios of batteries. In most cases, if I understand you correctly, a virtual one doesn't come with any control power. Is that something that I understood correctly?
Yeah, I mean, those deals are fairly non-standard. I would say there are, I mean, to your point earlier, there are more virtual tolls that have been signed. I think there are far more physical tolls that are negotiating at the moment and maybe financial ones. But virtual tolls, indeed, especially through were enabled in Germany. The beauty of those deals is that for the off-taker, you don't have to take control on assets. So you don't necessarily have this physical risk that to break or to cause a live damage, sorry, on the asset. That is the job of the seller of the flexibility. At the same time, the seller then needs to have the ability to A, steer the asset and connect the asset. B, the seller needs to be in a position to act as a balancing responsible party, so to exchange megawatt hours to the off-taker, and BSP, or to delegate this to someone else. So BSP is the person that offers ancillary services effectively. And it's not every seller that can do it. You have very specific sellers that have the ability to do it. Some others will subcontract it. So someone that is not yet a BRP or a BSP in Germany can find a BRP and or a BSP to do the job for them. It's totally doable. But I would say what's easier for the clients, typically what we observe is the one FPA at the physical FPA, because then, it's very clear the off-taker takes full control, of course, within the limits, the technical boundaries set by the client. And then the full financial FPA is also, I would say, a bit more simple than the virtual one on the paper. The only difficulty is that it brings a third party. So it's not only like an off-taker and a seller, there is someone in between, which is, the optimizer, the one touching the assets. So I would say overall, we will see probably going forward a balance between physical and virtual. I expect personally, I might be wrong, but less financial FPAs to be signed for the reasons that I've mentioned. But the future will tell at the same time. So we don't know. I expect a lot of physical FPAs will be signed going forward, quite a lot of virtuals as well. And then all of them have pros and cons depending on the seller and the buyer. So there will be a mix of those two things, and that's really good actually.
Yeah, I mean it's nice because it can cover the structure of the market, that you have battery developers who are less elaborated on their trading and maybe not even having any opportunities there. And for those, I understand from you, physical FPA is the right approach because they don't need to deal with several contract parties. They have lower risk. But you mentioned already that if you have a physical FPA, that there is more things that can break, let's say, in a very high level. So maybe before we get too much into the pros and cons and revise that, maybe starting on the physical FPA side, there are probably various constraints that go in here, and constraints that need to be also going into the contract. Because when I think about flexible grid connection, when I think about ramping constraints, when I think about other availability or regulatory risks, does that mean the physical FPA is more complex? And what are the, let's say, the breakpoints when discussing these physical FPAs? What do you really need to look out for, both as a seller, but also as an off-taker? Because I mean, as a seller developing batteries, what do I need to be careful if I want to have a good physical FPA afterwards, not to get into too big constraints on the ramping constructions and so forth? That might be very interesting for our listeners.
Yeah. And that is why, there is only so far one physical FPA that has been signed in Germany. It's really because it is complex to structure effectively. That's also why at ENGIE, we don't only have traders that, price and take risks and manage risk effectively, and not only originators that are, the people that bring the deals in. We also have structurers in between. And that's exactly to be able to structure, similar to PPAs, to structure deals which are complicated and non-standard. So to your question, indeed, all those physical aspects around the technical parameters, the warranty terms, the boundaries from the grid operator, and all possible, parameters that we as an off-taker have to respect, they have to be in. They have to be discussed for two reasons. One, not to break the asset. That's fairly obvious. That's the constraint number one. Two, and that's of course very important for us, because each restriction has a price. It has a price, and that's also why you need to have these discussions with the FPA off-takers at fixed price very early, because you might ask, like, you run your request for pricing structured in different manner, you ask for pricing, then you start to negotiate, and step by step you potentially will realize at least that your term sheet is not including this or that risk. So for instance, that there is no liabilities around the off-taker if they break something, or that the grade constraints were not taken into account. All of these things, they have to be looked at very carefully. That's our job as originators and structurers, effectively, to ask those questions, because they have an impact on the battery, they have an impact on the price of the contract. And that is why I think that fixed price FPAs are actually quite nice, because they force people to look at things. They really do force people to look at all potential risks. Physical risk is one. Regulatory risk is, of course, another one. Like, what happens if the exemption on batteries in Germany goes out? What happens if there's a new market, like a capacity market or inertia coming? What happens if, so many possibilities, effectively. And that is the job of structurers, together with originators and legal people as well, to properly represent those things, so that when this happens, if this happens, then we have a clear structure and a clear repartition of risks. There is nothing worse than like a contract that looks nice on paper, a nice price, but like when something happens, it's not described, it's not structured into the contract, and then nobody really knows who has to pay for what. I think there the market's not yet to a point where the experience is sufficient to represent all the tiny bits and pieces, but at least having an off-taker that has a lot of transparency, and then you as a seller having an advisor probably that can help you to know what needs to be in there, at least the key pillars, is effectively very important, because you might otherwise sign a deal you seem super happy about, especially because the price looks nice. But then the first moment when something happens, then everything suddenly breaks apart, and then you have no way to charge liabilities, or you get penalized, vice versa, of course, by the off-taker in hefty fines that you were not expecting. So all of these things need to be properly represented. That's also why I would say they take more time to negotiate than merchant FPAs, those fixed price FPAs, because you really need, it's a long-term marriage, right? It's something, for 7, 5, 10, 3 years, whatever the duration of the deal, you need to be okay and like to be aligned effectively on who does what, who takes which risk, right? As opposed to a merchant contract where you sometimes more have like the optimizer that is responsible to make as much money as possible, but where principally I would say the seller, so the asset owner, is willing to take risks, and that's the fundamental difference. They are willing to take risks. That means that if something happens, and if some new constraints were to appear, philosophically speaking, at least, those should be for the seller, and rather than for the buyer. In a fixed price FPA, there is a way to say, look, the buyer has to take this and that risk, which is not necessarily the case in a merchant optimization contract, because it's very, very clear the market risk is fully borne by the seller, sometimes without knowing it, but at least it's very clear that they take the optimizer risk and the market risk. So the balance of risk is completely one-sided, I would say, in such agreements. The only thing that the asset optimizers have to do is to respect the warranties as described into the contract. That's it.
Yeah, and I mean, there's one constraint, which, I mean, regulatory risk is something which is of course hard and can go in various directions, but I have the feeling in the German context, but also in many other markets, grid constraints are getting more and more on top of things. So would you say flexible grid connections, how we see it in Germany, or grid limitations can also be ramping constraints, are the main constraints that you need to take into account, and then can change the value or the price of a fixed price physical FPA? Or would you say there are?
Yeah, I mean, the grid constraints are one of them. It's not the only one. You also have all the warranty terms. And I think some optimizers, without mentioning name, the ones that have experience are really already communicating a lot on that, which is great, to be honest. Because it's one thing to have a value, that comes from Aurora or these kinds of people, but like if effectively you don't account for all the warranty terms, let's say you have to have a stupid example, resting periods of X and Y between two cycles, or the degradation curve is not exactly the one that was used in your investment memo, or the number of cycles is suddenly constrained, or all these things basically, then you lose very quickly a lot of money. And that is also something that explains sometimes the differences between the fixed price that are communicated to clients. I'm convinced personally that a lot of off-takers do not exactly know what they price. And that some of them would, for instance, give the same price for 1.5 cycles per day versus 2 cycles per day. It has a large impact, right? The people really doing optimization know it effectively. Everybody is not at this level yet, which is good if you're a seller. I would say it's very good to be on the sell side at the moment in Germany at least. But it's clearly something. So the warranty terms are very, very, very important. It's it can reduce the impact. The impact can be as large as 30% easily on your toll level between two batteries that look, on paper, very similar. One client will get 100 euro, the other one will get 130, whatever the price is, it can be very impactful. So that is the first thing to look at. So the more constraints, the worse, of course, the optimization. You might be saving on CapEx and OpEx, but you will lose out on revenues also. So you need to be pricing this very, very well. And then on the grid side, yes, I agree. Those can be very impactful. The ramping rates that we see from some DSOs going in the direction of like even 15 minutes or even 30 minutes, we've heard in the last weeks, is a disaster for the value of a battery. Let's be very honest, it's a disaster. So whomever has like a connection that has those ramps constraints will make far less money than someone that doesn't have it. And there again, we speak of double digit differences very, very quickly. The flexible grid connection all depends. It all depends how they are defined and what is behind this. So I think generically speaking, batteries, and we have studies out there that demonstrate it very well, they are rather helping the grid. They are charging when there's too much wind or solar, and they are discharging when it's the opposite. So fundamentally speaking, they should be rather helping than not helping the grid. And that's an asset which is rather grid friendly, I would say, or grid supportive. Still, it can be a constraint, right? So if suddenly the DSOs tell you you can't charge for whatever X hours a year, or I might cut you from this time to this time every whatever Sunday, or whatever the constraint is, any constraint is bad for an optimization revenues. The question is how bad is it basically? So the less constraints, the better. There are constraints that are not too impactful. The ones that tend to follow the sun, I would say, are not necessarily the worst. The ones that are more theoretical and just like, like conceptually not necessarily supported by anything which is market driven are very, very painful, very painful. So when you buy an asset, you need to be careful.
So also local constraints, saying that, like, let's say more transmission grid related constraints that might not be market related constraints, because the transmission grid constraints can be various, and in southern Germany than in northern Germany it's different, and the market is still the same. Okay, but the conclusion from what you have been saying now, that every FPA, especially on the physical side, is a very different one, and it's actually very hard to compare them, makes it probably less valuable to not benchmark, but to compare prices, right? Because if you give me a list of 10 different tolling agreements for the same battery type, and the devil is in the detail, it doesn't really help me to benchmark them. I really need to understand each difference, and then that's really driving the valuation.
Yeah.
So because of course, why am I saying that? Some of our competitors like to do this benchmarking. We are more focused on like estimating the value based on let's say the exact configurations. And I think this is a big difference to a PPA, because even though you can say a fixed price solar PPA, it makes a difference whether negative prices are included or excluded. But what you just said, you mentioned 2-3 examples, which is a 2-digit percentage change. So yeah, when looking at physical fixed price FPAs, you really need to look into the details, because otherwise
Not even only physical, all the FPAs, virtual or
Yeah.
whatever, depending on the parameters that are
Mhm.
underlying this, virtual parameters or real parameters, they have a large difference. But if you focus, let's say you want to compare two FPAs, for similar batteries, I completely subscribe to what you said. I think there is a lot of players out there that pretend they can benchmark. It's very partially true, to say the least. It's of course impossible. I think at the moment it is still possible because there's not so many batteries out there. So pretty much the batteries have all started in the same date. That's the first thing to say. Same technology or warranty terms. But if you look at a battery that has started in 25 versus a battery that will start in 27, or 28, let's say you are now in 28, how do you compare them? I mean, how do you compare the battery that starts in 28, which is a 2-hour, 2-cycle battery, efficiency 85, all that is fine, versus the battery that has started 3 years before, sorry. There is 3 years of degradation. How do you know the exact degradation? I mean, you don't have the people doing benchmarks don't have the compare of the exact, value of the degradation of the battery. So if some optimizer in 28 says I can make 100 euro with a 2-hour battery, and the other one is saying I can make 70, it might be just as good as the performance. It's just that the battery has 3 years of degradation in between. So that's the first thing. Then all the warranty terms, and I mean, you need to look at contracts to understand the warranty terms. It's like hundreds of them potentially. All of these have a very, very big impact. And so in terms of percentage point of differences, not only the year matter, the starting year, of course, of the asset and the degradation, but all the warranty terms. So what was the degradation is one thing, but what were the warranty terms that were supporting this battery that was starting in 25 versus the one that started in 28? What were the grid constraints that were behind? What was the size of the battery? The size matters also to a very large extent, of course, because liquidity is typically something which is underrepresented in all the benchmarks. An asset that has 100 megawatt to trade will be making probably in euros per megawatt less revenues than the 10 megawatts because the 10 megawatt can capture much more spreads because it's smaller to go into the market effectively. So the liquidity of the market will also play a role. But I think coming back to your point, and we see people coming from the renewable PPA world where they run benchmarks and then can effectively help the client to know where the fair price is. For a battery, this will be impossible. Let's be very clear. I can stand for my word on that one. This will not be possible for the exact reasons that I've just mentioned. So it's a pure illusion to say that you can really benchmark those things. I think the people that do this exercise haven't negotiated a lot of contracts yet. They will realize once negotiating that this is really not possible, seeing the deltas in prices per each type of parameter. So it's not going to work. The difference with a renewable, a renewable asset doesn't degrade so much. Well, degrades maybe a bit, but not so much. A battery really degrades. So comparing results from an optimization is simply impossible only for that reason, from year to years. But on top of that, if you add all the warranty terms and all the potential agreements, in a fixed price FPS or the representation of risk, somewhat that basically takes redispatch risk or doesn't take redispatch risk, will maybe not have exactly the same optimization logic behind, then you have also far bigger differences. So that is something which is, I would say, quite important to challenge. Plus, I mean, the ability to trade is also fairly different between partners, but it's not so different. That's also one of my contrarian views sometimes. I firmly believe that the algorithm to optimize a battery are not that rocket science. Effectively, we know that because we've done a lot of benchmarks. I've been in many companies, and the algos pretty much always look the same. So pretending that your algo is superior is probably a very hard sell, I would say, or very strong point of view that either means you are maybe super strong and you have discovered something that the market hasn't, so you're beating the market consistently, or it means you might be doing something like insider trading that unfortunately probably still happens those days, or you have, I don't know, I've been lucky. Maybe that's maybe also the thing. So you might be very good one year and less good the other year. So I think all in all, there needs to be a bit of reason in this market. People already having experience and communicating on the results are really helping, although they might be merchants, so some optimizers already do it. That helps to get a common sense versus the curves that people like you effectively are selling all day long. That helps to come back to reality sometimes and check what's really doable with a concrete asset with concrete constraints. So that is, I think, the best thing you can do. And then benchmarking makes for me, very, very little sense. That's also why I think once you get into a fixed price agreement, then just, go into this agreement, believe in the reasons why you went into that, and just go along with it. Don't start to try to see if you were able to make more or less money elsewhere, because the comparison is simply impossible. That's the truth.
Yeah, so we've been talking about fair value already, but the question still remains like, how do you price that? So I would be curious to hear, how do you price on your side fixed price tolling agreement?
Yeah, it's a good question. Thanks for asking, actually. So I think to come to the fair value of a toll, you need to start, of course, with which type of battery you have, or which type of asset or overall. And here we speak only about a fixed price toll, by the way, just to be clear. So to start with, I think you need to look at which battery you have. So the technical parameters of the batteries are the starting point, of course. So the megawatts, megawatt hours, cycles per day, cycles per year, round trip efficiency, degradation plays, of course, a big role. Any other constraints in terms of ramping, in terms of state of charge, in terms of degradation, in terms of depth, of discharge and charge. All those technical parameters and any others that can be coming from the warranties or from the grid operator. That's the first thing to look at. Obviously, on top of it, the starting date. I think the starting date is extremely important. So a battery that starts in 26 will not make the same money than a battery that starts in 28. That's, I think, goes without saying, but that still is quite important when you compare the value of a 2027 versus a 29 toll. It's not the same for the same duration. And then you need to look at the risk. So the market risk, especially, is the biggest component, of course, of the toll. So you can say the market risk is a function of the duration of the toll. So like a 5-year toll will not have the same risk as a 7, 9, 10-year toll, obviously. And then the market risk component will take basically a bit of a hit on the final price. But that's not like reducing value, it's just pricing risk, I would say. So there is nothing that is being stolen anywhere by anyone. It's just that the toller has to take a risk. And for this risk, they have to take, of course, provisions to be able to manage this risk in a good manner. So market risk would be the first thing. You start from the battery fair value, I would say, depending on the technical parameters and constraints. You add the market risk to it, then you can look at the credit risk. So credit quality of the counterpart is very, very important on both sides, by the way. So not only the toller, but also the seller. And for this, you of course need to run a small credit check of the two counterparts and check how creditworthy is the toller, so the off-taker, but also how creditworthy is the seller. The reason is that if you fix a price, you're basically swapping this fixed price, so the market price risk for a credit risk. That's the case for all contracts that are fixed price deals. And that means that if the credit quality of one or the other party, especially the off-taker, is not so good, then effectively you are increasing your risk. So you think that you've reduced your price risk, but actually the overall risk has increased because the credit risk has increased. So credit, to cut a long story short, is a very important factor. And you always have like a provision for credit risk, which is covered via the contract, of course, and that can have an influence on the price. It's a small one, but still to take into consideration in terms of risks. And then the other things that can play a role as well are contract terms. So like, what did I swallow, kind of, if I may say it like this, into the contract as an off-taker? Which risk did I accept to take, like regulatory risk, for instance, around redispatch, or regulatory, for instance, upside, like capacity markets. So the balance of all of these things which are non-technical, but that could happen. What are the liabilities and penalties that I have to pay if I'm not delivering the set point, or if I'm not respecting the technical parameters? All of this basically plays a role in the downside risk that each and every party has, and that has an influence on the price. So again, you start from the best fair value, which is depending on technical parameters and start date. You deduct market risk, credit risk, and then potentially some contract terms that have a price influence. And then if you look at the positive side, because of course batteries also bring positives, what typically people price as an off-taker is two things, I would say. One is the portfolio effect. Second is I would call it the strategic top-up that you can put onto a battery. Starting with the latter one, strategic top-up, why do people do a strategic top-up? Well, I mean, if you want to start playing a role into the battery landscape, and if you really need or want to have a battery, if you're in this game also maybe only for the volume and not so much for the money, then you will put a top-up just to get the deal through the line, so to say. That typically applies for the first deal, not so much for the latter ones, so to say. So the more flex you have in a portfolio, or the less needs for flex you have in your portfolio, the less willing you will be to pay, of course, for flexibility, because you simply don't need that much. And then the other one is the portfolio effect. So the portfolio effect is the hedge or the hedging effect that a battery has on your portfolio, which needs to be properly represented, which is complex effectively. So for the people, for the utilities that have renewables and clients as well, so downstream clients, they can typically try to represent the hedging effect then the cash flows of a battery will have on the cash flows of their downstream portfolio or on the cash flows of their renewable assets. And that in turn can, lead to a bit of a value which is given to the asset, because the asset is seen as helping the portfolio, and that in turn can then give you a top up. So all in all, that's basically it.
And just on the last one, like the hedging effect, is that really a value that is given back to the asset owner? And is that given back to the asset owner only if we have a strong competition between the off-takers, right?
I would say it's a fair question indeed. I mean, first of all, I think that quite a lot of people don't know which risk they have in their portfolio. So that's the first thing. So to be able to give a top up for the portfolio effect, you need to know what's in your portfolio and what are the risks in there. Otherwise, you cannot really measure and then give any top up. So that's point number one. Point number two, I still think that we are going to be in a market that will be increasingly competitive. So indeed, it's going to be like everyone will pretty much come to the same fair value of a toll going forward. I don't think there will be a lot of discrepancies. What will make a difference is indeed the portfolio effect and the strategic top-up more than anything else. And that is indeed then a reason why you might want to really look at this, because going forward, since the competition will increase, to be competitive, you will have potentially or probably to look at your portfolio effects to distinguish yourself, at least on the price. Next, of course, to the rest of the contract terms that play a big role. It's not only about the price. But yeah, so that's how, from my perspective, you move from the BESS value, which can be seen as the merchant value of a BESS if you optimize it without any risk, basically. Let's say it's 100 units, and then you go down a bit because of the market risk, the credit risk, and the contract terms that are all things that are typically more negative for the off-taker, and you go up by the portfolio effect and the strategic top-up, and all in all, that gives you the toll fair value. And this toll fair value, that's maybe the last point, it's something that moves over time. That's something that also people sometimes don't fully comprehend. The pricing date matters. That's something which is very important. So if you ask for a price today, or if you ask for a price, theoretically speaking, in 1 minute, it would not be the same, but let's make it more simple. Like in 1 month from now, the price will probably be different. The reason is that the projection of the revenues of the assets in the future also depend on the prices that can be found in the market, right? Because the money you make on the battery is a function of the price level, the volatility around those price levels, and the ancillary services revenues or the top up that you can have in terms of ancillary services. So since the volatility and the absolute price levels are both moving every now and then, every minute, effectively, then you can say, and you could argue, that the price of a toll should change every minute. Effectively, I think what people do is that they don't change it that much, but like every month, basically, if you ask for a quote, you might get a different, at least slightly different pricing for the same battery. That's something to keep in mind as well. So it's not necessarily a fixed value over a year. So you should not be surprised if your off-taker updates from time to time this value.
Perfect. Yeah, but would you say there are differences in how you price a fixed price tolling across Europe?
I would say fundamentally not so much. Of course, the liquidity in all the markets plays a role. So, market risks all in all might be higher or lower. So the ability to hedge is probably having an influence. But overall, I would say no. You still start from the technical parameters of the battery, remove market risk, credit risk, and then contract terms, and then look at portfolio effect, and then maybe like a strategic top-up. And of course, maybe what makes a difference across markets is like the other revenues you can have on the site, like capacity market or inertia, or like this kind of subsidies that you can sometimes have, which might lower than the toll levels because, simply the clients don't need those toll levels. That's something that is a bit of an intrication, which sometimes I would say play a role.
Perfect. Yeah, maybe to also get a bit more on the wider scale. I mean, we talked about some examples in Germany, but we also talked quite on the European side. Would you say we will see a very similar development across all European countries, with regards to FPA structures, or would you expect that there's going to be differences between the countries, and why would you expect differences between countries?
It's a very interesting question. So, I mean, I'm not science. I don't know all the countries, but my guess would be that the countries that have the highest liquidity and the highest renewable penetration, or at least ratio between renewables versus firm capacity, will see the highest liquidity, so Germany being the prime example, and the highest volatility in comparison term to other markets. And those are the markets where you will see most FPAs happening at fixed price, at least, because you can hedge. So, I mean, going into a fixed price agreement as a trader is only meaningful if you can manage the risk. Otherwise, you're increasing your risk effectively of your portfolio without realizing it sometimes. So if you can't hedge internally or externally one way or the other, then there's no real point to go into a fixed price FPA. And that means that the countries that offer the best hedges or the best liquidity in the market, the best ability to hedge via the market or via counterparts, are going to be the ones that will see, I would say, the most fixed price FPAs. In other markets where it's a bit more tricky, or where the fixed price are too low, because simply the market has already solved most of the issues, the UK is a good example, then the tolls will not do their job. That's also why you have far less tolls there. A, because it's more difficult to hedge. You don't have the same liquidity and the same duration of quotes into the markets. B, because the levels being not high enough to compensate for the cost of capital decrease, basically, that the toll brings. So people tend to go for floors. That's also why you see floors in those markets. And then the key question is, as you said in the intro, I think some countries also have some, capacity markets or subsidies or disguised capacity markets, so to say. So there is a revenue stack that comes A, from the government, and then B, from the market. And then the question is, how high is the one from the government? What's the top up that you need to bring? Is it then in the form of a toll, of a partial toll maybe? And then how high is the price of each of these structures, so that you can be happy on your return? So I would say, generally speaking, fixed price versus merchant, you will see a mix depending on the level of the toll you can get, the duration of the hedging that you can do as a trader. And that's where the most liquid market will be dominating this space. And then in terms of virtual versus physical or financial, I think there is no real difference between the markets. I mean, it might be more difficult in zonal prices market to do virtual tolls at, cross zones, effectively, I would say. So you might go for more individual asset or individual zonal portfolios, at least. The financial tolls, I think, can be done from anywhere to anywhere. Effectively, it's just a pure financial product. So there is even no need for a battery, effectively, behind. So I would say all of these three types of tolls, physical, virtual, financial, should be probably having the same value in all the markets. Maybe the difference would rather be on the fixed price versus partial fixed price or merchant, depending on the quality of the levels of the tolls you can get at fixed price between the markets.
Perfect. Yeah, super interesting. And thanks a lot for taking it a bit on the higher level now, because I think it's not only interesting for investors, for players, but that's actually also some really interesting takeaway potentially for policymakers, because it defines to what degree do you really need support mechanism for batteries or you don't. And it sounds like Germany is probably less of a case, but market with significantly less liquidity might struggle to see that battery increase without any support mechanisms. And that in turn can also be quite an interesting takeaway on the investor side when you think about, will I focus on a market which maybe has volatility but very little liquidity? Is that something where I can get tolls and therefore also get in projects that I can maybe afterwards sell to an investment fund or similar infra investment fund? Yeah, we're hitting the time. Is there anything else you want to share with us? Any last comment?
I think it's great to be able to discuss about those structures. So thanks a lot again for the invite. My guess is that we will see more of these structures and deals signed this year. We hope to be able to be part of them, to be honest. So I'd say the competition will grow. We will see more people doing those things. They will see that the financial world is following. I think to negotiate those tolls, you really need to account for the fact that they are complex products, non-standard by all means, at least for now. So you need to account for quite some time. to negotiate them. I think being surrounded by advisors on the legal side is great, but also on the trading/structuring side for the fixed price ones at least. Be aware of your warranty terms. I think it's super mega important to be really aware that they have a real price impact. And if you want to discover what the price impact is, I would really always encourage the people the sellers to go to traders and ask for a fixed price, because they will see the real impact. I mean, they can also go to Aurora, obviously, to see the difference in the curves, but to see also the traders' view on this might also be a nice complement, even though they don't want to go for fixed price in the end. It's totally okay. Everyone has a different appetite, but just to see the impact, I think it's quite important to fight as much as doable for your grid connection, to be as flexible or as flexible, as free as possible, so not too constrained. I think it's quite important. And yeah, basically take your time. Don't rush those negotiations, because those are very impactful projects that can last for quite some time. Be very aware of credit. I would say that's also very important. So the creditworthiness of an off-taker is extremely, extremely important, because that is someone that can either touch your asset and potentially break it. So they have to pay the cost of breaking it, or a portion of it, or they are basically taking a fixed price for you. And if these guys are not creditworthy, then you basically are increasing your risk, because they might be going bust, and then you're back to being merchants probably in a very severe market condition, because that's why they went bust in the first place. So credit is extremely important. That's the alpha and the omega, as I often say, from fixed price deals. It was the case in PPAs. It's going to be the case in FPAs, very similar. And maybe the last word is, I think that, comparing merchants to fixed price, I think there is a market for everyone in Germany, because you have different appetites for risk, you have different size of assets. I think larger asset sizes are often connected to depth, so they will always have a portion of fixed price. The question is how much. But there's probably space for everyone in this market, and I think that it's one of these markets in Germany where you have plenty full of players that can do merchant or full toll or partial tolls, be it physical or virtual. If you compare this market to other markets elsewhere, the spectrum of possibilities without having to spend a single euro of public money, taxpayer money, is simply amazing. So that's I think maybe a nice concluding note. I think Germany is second to none on that aspect. There is no taxpayer money that goes in there, and still the business case makes sense, thanks to people taking risks, most of the time being utilities or traders.
Perfect. Yeah, I think these were really some good conclusion words. So nothing to add from me on that one, except for big thanks. Thanks for joining us. It was really a pleasure and really interesting to get into the deep dives and really understand where the differences to the classical PPA structures are coming from.
Thank you so much, Casimir. And if any of your listeners have projects in Germany, they are more than welcome to talk to us.
Thank you, Martin.
That was Casimir Lorenz, Aurora's Managing Director for Central Europe, talking to Martin Daronnat, the Head of Flexibility in Structured Origination at ENGIE. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow the podcast via whatever platform you use.